Hello and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today is November 5th, 2025, and we're taking a close look at USDJPY, which is currently at a fascinating crossroads. We'll start by breaking down the significant news events shaping market sentiment before diving into a multi-timeframe analysis of the charts. The dominant theme right now is the stark policy divergence between a hawkish U.S. Federal Reserve and a persistently dovish Bank of Japan. Fed Chair Jerome Powell has recently pushed back against market expectations for a December rate cut, which has been a primary driver of U.S. dollar strength. However, this dollar strength is being challenged by serious concerns over a prolonged U.S. government shutdown, which has now hit a record 35 days. Investors are worried that a continued deadlock between lawmakers could inflict real damage on the U.S. economy, which is causing some risk-off sentiment. On the other side of the pair, the Japanese yen is being weighed down by the Bank of Japan's reluctance to commit to further interest rate hikes, despite inflation remaining above their target. Adding to the yen's weakness are expectations that Japan's new Prime Minister, Sanai Takaichi, will pursue aggressive fiscal stimulus. But the biggest wild card for the yen is the constant threat of intervention from Japanese authorities to stem its weakness. Finance Minister Katayama recently warned that patience has limits and traders are on high alert for intervention, especially as we approach the key psychological level of 155. Now, let's turn to the daily chart to see how these fundamental factors are reflected in the price action. Looking at the bigger picture, we can see an enormous rally that took the price from around the 141 level in August to the current highs above 154. This powerful uptrend underscores the fundamental story of a strong dollar and a weak yen. However, notice the sharp, sudden drops we've seen in the past, like the massive red candle on July 11th where the price fell over 2%. These types of moves are often characteristic of market reactions to intervention threats or actual intervention from the Bank of Japan. The primary resistance level to watch overhead is the psychological 155.00 mark, a level where analysts believe intervention becomes highly probable. Beyond that, news reports have highlighted 155.88 and 156.88 as the next potential targets for bulls. The long-term highs from back in mid-2024, up near 162, represent the ultimate ceiling for this pair for now. On the downside, we have a crucial support zone that was recently formed. The area between 153.25 and 153.65, which was resistance throughout late October, has now become a critical support level. A break below this would be a significant bearish signal in the short term. Further down, the 151.50 to 152.00 area offers another layer of strong support, followed by the psychological 150.00 level. Now let's switch to the 15-minute chart to analyze the most recent price action from the last few days. Here we can see the impact of the U.S. government shutdown news in real time. After consolidating around the 154.20 level for much of November 3rd, we saw a significant breakdown yesterday, November 4th. The price fell sharply, breaking through the 154.00 level and finding a temporary bottom near 153.31. This shows that while the long-term trend is bullish, short-term news can cause significant pullbacks. The price is currently consolidating in a tight range, struggling to reclaim the 153.65 level, which corresponds with the support zone we identified on the daily chart. This tells us that the market is in a state of indecision right now. Bears are pushing down due to shutdown fears, while bulls are defending this key support level, likely seeing this as a buying opportunity based on the interest rate differential. A failure to break back above 153.80 on this time frame would suggest more downside is likely. Conversely, if buyers can push the price back above 154.00, it would invalidate the recent bearish pressure. Traders should be watching this consolidation pattern very closely for the next breakout. So, let's bring it all together and switch back to our daily chart for a final summary and outlook. To recap, The key price levels are absolutely critical right now. Immediate resistance is at the recent high around 154.50. Above that, the major hurdle is 155.00, which is not just a technical and psychological barrier, but also a potential trigger for BOJ intervention. Key support lies at the 153.25 to 153.65 zone, which the price is currently testing. A break below this area opens the door to 152.15 and then the 151.50 support level. Now for our unbiased predictions. Our bullish scenario, which I'd place at a 60% probability, is that the fundamental driver of rate divergence will eventually win out. If upcoming US ISM and ADP employment data come in strong, we could see a break above 154.50 and a retest of the 155.00 resistance zone. This scenario becomes more likely if we see any positive developments regarding the US government shutdown. Our bearish scenario, with a 40% probability, hinges on worsening shutdown news or surprisingly weak US economic data. A decisive daily close below 153.25 would confirm this bearish momentum and could trigger a slide towards 152.00. Of course, any actual intervention by the Bank of Japan would immediately validate the bearish case and cause a rapid drop of several hundred pips. The main things to watch for are the U.S. economic data releases scheduled for later today, any headlines regarding the shutdown, and any verbal warnings from Japanese finance officials. This has been our in-depth look at USDJPY. Thank you for watching Explain the Charts. Before you go, please remember that this video is for informational and educational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own research and consult with a professional before making any investment decisions.